This is the roadmap for the course. You will learn accounting with real-life examples. First, you start with the company setup. You started a food trading company. You have invested funds in the business. Writing owner's capital in accounting refers to recording the owner's investment or withdrawal of funds into or from the business. Here is how you typically handle owner's capital transactions in accounting. You will learn about the recording owner's investment in the accounting system. When the business starts, the owner typically invests capital, money or assets into the business to get it up and running. This initial investment is recorded in the accounting records. Make a purchase transaction with capital amount. It typically means you are using funds directly from the business's capital. For example, you might be buying inventory, equipment, office supplies, or any other asset needed for the business. Certainly, in accounting, purchase transactions can broadly be categorized into two types based on how they are financed or the nature of the transaction. These two types are purchase transactions with cash or cash equivalents. These transactions involve the direct exchange of cash or cash equivalents for goods or services. Purchase transactions with credit or on account. These transactions involve buying goods or services on credit, promising to pay the supplier at a later date. Here is how you handle this type of purchase transaction. Example: purchasing supplies on credit from a vendor. You will learn how to record both the cash and credit purchases in an accounting system. Sales transactions refer to the process of selling goods or services to customers in exchange for money or other forms of payment. In accounting, recording sales transactions accurately is essential for tracking revenue, assessing profitability, and fulfilling financial reporting requirements. Here are key aspects of sales transactions. Recording sales transactions. Cash sales. When goods or services are sold for cash, the accounting entry typically involves debiting, increasing the cash account and crediting, increasing the sales account. Credit sales. When goods or services are sold on credit, the accounting entry involves debiting, increasing the accounts receivable account and crediting, increasing the sales revenue account. Here you will learn both cash sales and credit sales. Expenses involves recording and tracking the costs incurred by a business in its operations. Expenses are essential for generating revenue and are subtracted from revenue to determine a company's net income. These are ongoing costs incurred in the day-to-day operations of the business. Examples include rent, utilities, salaries and wages, insurance premiums, office supplies, and marketing expenses. In accounting, sales returns refer to merchandise that customers return to the seller after a sale has been completed. This could be due to various reasons, such as dissatisfaction with the product, receiving a defective item, or simply changing their mind. Handling sales returns correctly is important for accurately reflecting the financial impact on the business. Here is how sales returns are accounted for. Recording sales returns. For sales made on credit. For cash sales, you will learn to record both cash and credit sales returns. In accounting, purchase returns, also known as returns outward, refer to the merchandise that a business returns to its suppliers after a purchase has been made. This could occur due to various reasons, such as receiving defective goods, incorrect items, or overstock situations. Handling purchase returns correctly is important for accurately reflecting the financial impact on the business. Here is how purchase returns are accounted for. Recording purchase returns. For cash purchases. For purchases made on credit. Here, you will learn to record both the credit purchase return and cash purchase return in accounting. Borrowing a loan in accounting involves recording the inflow of funds received from a lender which the business is obligated to repay over time, typically with interest. Here you will learn how the accounting for borrowing a loan is typically handled. When a business borrows money, it receives cash or a deposit into its bank account from the lender. Repayment of the loan. The business makes payments towards the loan, principal and interest. Learn to record the loan repayment in the accounting system. In accounting, a sales discount refers to a reduction in the price of a product or service that a seller offers to a buyer as an incentive to prompt early payment or to encourage bulk purchases. Sales discounts are used as a marketing strategy to accelerate cash flow and increase sales volume. Here is a detailed explanation of how sales discounts are accounted for in business transactions. In accounting, a purchase discount refers to a reduction in the purchase price of goods or services that a buyer receives from a seller as an incentive for early payment or prompt payment of an invoice. Purchase discounts are often offered to encourage buyers to settle their invoices quickly, thereby improving the seller's cash flow and reducing accounts receivable turnover time. Here is a detailed explanation of how purchase discounts are accounted for in business transactions. In accounting, salary payable refers to the liability that a company owes to its employees for the work they have performed but for which payment has not yet been made. It represents the amount of wages and salaries that are owed to employees at the end of an accounting period. Here you will learn the recording of salary payable in the accounting system. A financial report typically consists of two main components: the profit and loss statement and the balance sheet. These documents provide crucial insights into a company's financial performance and its overall financial position at a specific point in time. The profit and loss statement, also known as the income statement, summarize the revenues, expenses, gains, and losses incurred by a business during a specific period, usually a fiscal quarter or year. Its primary purpose is to show whether a company has generated profit or incurred losses from its operations over the reporting period. The balance sheet provides a snapshot of a company's financial position at a specific point in time, typically the end of a reporting period, example, end of year. It summarizes what a company owns, assets, what it owes, liabilities, and its net worth, equity, calculated as assets minus liabilities. Importance of financial reports. Decision making, investors, creditors, and management use profit and loss account and balance sheet information to assess a company's financial health and performance. By analyzing both the profit and loss statement and the balance sheet, stakeholders can gain a comprehensive understanding of a company's profitability, operational efficiency, liquidity, and overall financial stability. These reports are essential tools for strategic planning, financial management, and evaluating investment opportunities. I have created a complete course for accounting. The name of the course is Accounting Made Easy. The course link is given in the description.